Your client, Alfred Otieno, wishes to invest shillings 500,000 for 2 years with the interest compounded, but with the right to withdraw at a moment's notice. The following investment options are available. Option number 1, invest with the Nyumba Building Society, currently offering an interest rate of 14% per annum after tax, with interest paid half yearly. Interest paid half yearly. Every 6 months, they shall be paying interest. Option number 2, invest with Kijiji Bank Limited at an interest rate of 17% per annum, with interest paid annually. Once a year, every 12 months, they pump in interest compounded. Option number 3, invest with FIDA Bank Limited, which is offering 16% per annum, interest paid every 3 months. So using suitable computations, advise your client on the best investment option he should consider. So, ladies and gentlemen, in this case here, which one is the very best investment option that he should be able to consider? It's compound interest. It is the formula that we were taught in primary school. In primary school, where they told us amount equals principal into 1 plus r raised to power n. Is it possible for somebody to share this question in the groups? December 2022. December 2022, is there somebody? Somebody must be having this question for sure. So I would expect you guys to do what you're to. Simply move ahead and do what you're, share it in the group. And once you share it in the group, simply write there shared. Write there shared. I will be so happy if that happens. So you don't waste time, really. Right. So is there somebody who has been able to share it in the group? Done. Thank you very much. I'm so happy. So remember the compounding interest formula: amount equals principal into 1 plus r raised to power n. These are very, very important formula whenever you want to get the compounded amount, whenever the rate of interest is on a compounding basis. So then we shall start, ladies and gentlemen, by looking at the first option. So option number 1, they are calling it a nice name there. Option number 1, what are they calling it? Option number 1, they are calling it Nyumba Building. So we are calling it Nyumba Building. Nyumba Building. So Nyumba Building, what are the terms there? They have told us in invest, of course, the principal being invested is 500,000. The amount to be invested is 500,000. And they're telling us that invest with the Nyumba Building Society, currently offering an interest rate of 14% per annum after tax, with interest being paid half yearly. So in this case here, the rate of interest, ladies and gentlemen, there is 14%. So R is 0.14. R is 0.14, but remember this 0.14 is per annum. And in this case here, the interest paying period is the year. Interest paying periods in the year, they have told us, ladies and gentlemen, that they are paying this interest semi-annually. They have told us they are paying it half yearly. So half yearly, how many months do we have there? We have 6 months. 6 months. Whenever they talk of half yearly, semi-annually, we have 6 months there. So then the number of times we shall be able to earn interest in the year will be equal to 12 months. And you're the ones who have just told me that they are paying interest every how many months? Every 6 months. they're paying interest semi-annually, half-yearly. Every 6 months, they're paying interest. So in this case here, the number of periods, interest-paying periods in the year are how many years? Got 12 months, 12 months, 12 months, and we're getting this interest every 6 months. So then how many times are we going to get interest in the year? How many times? How many times? How many times? These cases are not twice, yes, 2 times. Thank you very much. Now, please listen. Once I've known it is 2 times, then this formula must be adjusted slightly. This formula must be adjusted slightly. If it is semi-annual, if it is twice, we're going to get interest twice in the year, then this amount formula will remain as principal 1, but you see this rate has to be cut by 2, has to be divided by 2, because you see this is for a whole year, right? And I'm going to be earning this interest twice every 6 months. Then you come here, ladies and gentlemen, you come here, you are told, if you remember from high school, once you know that you are paying twice a year, we are going to increase this. So this end, if there are 10 years, we shall have 10 times 2, 20 interest-paying periods. So in this case here, remember the R, you divide the R by the number of periods in the year, and then you come and take this N, you multiply this N with 2 like that, with 2 like that, with 2 like that. All right. So what have I done? What I've done, if for example, ladies and gentlemen, I was told that this particular what year, interest is being paid to us quarterly, so 4 times a year, I would have divided this by 4 and multiplied this N with 4. So 4 concept here. So this is semi-annually. Semi-annually gives me interest-paying periods are 2, and these 2 I will come and divide the rate by 2, and then I increase this N by multiplying it with 2 like that. Ladies and gentlemen, would you kindly go ahead and give me the amount here? The principal amount being invested is 500,000. Into 1, we have here 1 plus the rate of interest is 0.14. The rate of interest is 0.14 divided by 2. And then what we shall do, once you have done this, we shall come and raise this with this 2 times number of years in the question given. How many years do we have there? How many years do we have in the question? How many years do we have in the question? 2 years. 2 years. So please ensure that you are able to raise. Ensure that you are able to raise. So you say 500,000 times, open bracket, you say 1 plus 0.14 divided by 2, you close, and then you look for the raised function. In most calculators, it has a raised function like this. Raised to, of course, 2 times 2 is 4. You raise this to 4. You raise this to 4. And then you tell me the answer. I can see from Esther 655, 398. 655. I can see from Esther 655, 398. 655, 398. Are we able to get that figure really, all of us? Are we able to get this figure really, all of us? 655, 398. I believe Ruth wanted to write there and 98, right? So please ensure that you know how to raise. And don't raise it with the 2 times 2, no. Actually, if I'm the one doing this, I'll come even and make this thing much easier for myself. I will say this is 500,000 into 1 plus, this is 0.07 raised to power 4. I can still make it better for me. This is 500,000 times 1.07 raised to power 4 like that. Raised to power 4 like that. So long as you know how to raise, you'll be able to get this number. You'll be able to get this number. So are we together really up to here? Are we together up to here, ladies and gentlemen? Are we together? Have we been able to follow up to here the amount we shall be able to get from this Nyumba society? Yes. So this is the amount we shall get. But you see, we are after the return. What return are we talking about? What in this case is the rate of interest? What is the rate of interest there? What is the rate of interest? Not rate of interest, but interest amount. So the interest amount we are looking at, we invested 500,000 We invested 500,000, but cumulatively we have gotten 655,398. And therefore, the interest, of course, will be amount minus principal. Amount is 655,398 minus principal of 500,000. So this one here will end up giving me, 155,398. That is the answer. That is the answer. And if you allow me, then I'll be able to go to the second part, the second option for this guy. The second option for this guy is pretty easy. The second option for this guy is pretty easy. What have they told us about the second option for this guy? What have they told us about the second option for this guy? Can I rub this? Can I rub this? Can I rub it? Can I rub it? Can I rub this? Can I rub this? Yes. So second option, you write there big title, option number 2. Write there big title, option number 2. Option number 2. So option number 2, what have they told us really? Option number 2, what they have told us, ladies and gentlemen, for option number 2, what they have told us here, is that we invest with the Kijiji Bank. It's Kijiji Bank. Kijiji Bank. We invest with the Kijiji Bank. And the Kijiji Bank, of course, the principal amount is still 500,000. The rate of interest, we need to pick the rate of interest. So Kijiji Bank, the rate of interest is 0.17. Rate of interest is 0.17. Number of years, of course, they're still 2 years. Number of years, they're still 2 years. And at this time round, interest is being paid annually. Interest is being paid annually. So if interest is being paid annually, this is a good examiner who is wishing us success. So I know that amount will be equal to principal into 1 plus r raised to power n. There is nothing like dividing this by 2, nothing like that, because interest is being paid once annually, not unless you want to divide this by 1, and then you multiply this by 1, which will be nonsense. So come here, so this will be 500,000 into 1 plus, the rate of interest here is 0.17 raised to power 2. So then this will be 500,000 times, open brackets, 1.17. 1.17 raised. So this gives us 684,450. 684,450. 684,450. 684,450. Why 2? I mean, option 2. You know, here we can't divide. The concept here is why 2? Remember, we were told from up there. Your client, Alfred Otieno, wishes to invest 500,000 for 2 years. N is 2. N is number of years. 2 years. We are doing this December 2022 question 1C. Okay, great. So then, having gotten this, are you guys able to tell me the interest earned? So interest earned will be this amount minus the investment. I'm so sure that you can give it to me. This amount minus this investment, minus that investment. So what are we getting? Somebody there? What are we getting? Somebody there? They're giving me a figure of 184,450. 450. So option number 3 is what I would want to see whether there is anybody who will be able to get option number 3 correctly. I'm giving you exactly 5 minutes. Give me option number 3 correctly, the interest under option number 3. right. So interest, according to 𝐨𝐼𝐟𝐞𝐫, it is 184 something, 184 something. Option number 3. Option number 3. Option number 3. Option number 3, remember the principal still remains 500,000. 500,000. Number of years in this case here, there are how many? They still remain at 2. But R, there is an abracadabra there. What have they told me about R? What have they told me about R? What have they told me about R? So they've told me that R is 16%, R is 0.16, and then they have told us that the interest will be paid after every 3 months. After every 3 months. So I need the periods, interest periods. Interest periods in a year. Interest periods in a year. Interest periods in a year. Interest periods in a year, ladies and gentlemen, we will always take this 12 months as the numerator divided by this interest is being paid every 3 months. Every 3 months. So we have here 3 months. So of course, this must have given you what somewhere there. It must have given you guys 4. Up to there. Are we aligned? Are we together up to there? Remember, I've already done this concept with you. Yeah, up to here is okay. All right, ladies and gentlemen, after you write like that, remember then that the normal formula for getting amount, a normal formula for getting amount will always be equal to principal into 1 plus R raised to power n. This is the normal one. But if the interest paying periods are 4, if they are 4 in a year, then I have to do the abracadabra, the fast ninja style. I have to cut this 4 there. Don't forget to also multiply this n by 4. By 4. All right. Then, ladies and gentlemen, our amount will be equal to the principal, which is 500,000 into 1 plus the rate. The rate here is 0.16, I mean, divided by 4 into 4 times n, which happens to be number of years, there are 2. Number of years, there are 2. So then this one will now boil down to what? The amount here will be equal to the 500,000, the 500,000 into this will give me 0.04. Is that the case really? If you divide, it will be 0.04 years. So plus 1, that gives me 1.04. Raised to power 8. Raised to power 8. Raised to power 8. So doing it that way, is there any student who is able to, ladies and gentlemen, in this case here, tell me, what is the final answer here? What is the amount? So according to Felix, it's 684, 284. 684, 284 like that. And remember, you had pumped in how much at the beginning? 500,000. So what is the interest there? What is the interest earned? What is the total interest earned? You take the amount at the end of the 2 years minus the principal. So the interest will be this minus 500,000. It gives me 184, 284. 184, 284. So is there any student who was able to get that figure? Is there any student who was able to get that figure from the word go? Or the most important question is, should they give us this kind of a question this time round? Are you now in a position of getting it right? So you can be forward thinking. Thank you so much. So between the three options, which option now is the best? Which one is giving these gentlemen the greatest amount? They can't twist English. FM is the easiest paper. Yeah, so is it option 1, 2, 3? According to 𝐨𝐼𝐟𝐞𝐫, invest in option 2. Invest in option 2. And now this brings me to the question, how good are you? How good are you with personal finance? Are we very good? Whenever they mention, because personal finance is in your syllabus, whenever they mention things to do with personal finance, what comes to your mind? I'm giving you exactly 3 minutes. You tell me, before I continue with this question on effective interest rate, what do you know about personal finance? All right. So I cannot see anybody mentioning anything about personal financial management. Yeah, like plan your finances wisely. You do investments. Money at disposal for investing. But remember, the first rule of personal finance is that we need to understand that money has value. Money has value, and that we are prudent or rational investors. We are prudent or rational investors. A rational investor is that investor who is able to look at the value of money. He's not that kind of a person, ladies and gentlemen, who will go to a club paying bills of 50,000 simply because you want to impress some yellow ladies, if you're a gentleman. Because when you invest in that kind of a way, the return is zero, if not negative. Any person who knows personal finance, first of all, you must know that money is a scarce resource. It only comes and stays on your way for a few minutes. If you don't stack this money somewhere, then automatically you will lose. So anybody who knows anything to do with personal finance, first of all, has to appreciate that money has got value. And if it has got value, number one, we must think about saving. We must think about saving. Saving, of course, we have savings. Savings, you'll be able to get interest rates, but quite small, because savings are not long-term. Savings are what here? Short-term. For example, you could be having what we call money market funds. Money market funds, these are markets where you are able to invest money in a shorter period, MMF, money market fund, short-term investment. Short-term. So you're saving basically. You have a basket here. Instead of putting that particular tin, used initially before these money market funds came, I remember what we used to do. We used to bring in some tins, and then of course we used to have some tiny holes. And then we used to save, in this case here, coins. But it was quite an unfortunate thing. But nowadays with money market funds like CIC, like Sanlam, and you need to know how to quote them in an exam. Like we have these fake guys called the CIFA. They normally say that theirs is giving a very good rate of return. But you see, they have got dark things in the market. There are people who are not saying very good things about them. CIFA. So you put your money there, and then, ladies and gentlemen, you can withdraw your money anytime upon giving them a notice, like a 2-day notice. A 2-day notice, you'll be able to get your money. You'll be able to get your money. All right. Then we have, of course, also as a savings scheme. As a savings scheme, you can save your money with government. You buy treasury bills. I love treasury bills because should I be broke, if it's a 91-day treasury bill, maybe I've given them, like, say, 200,000 and I bought some T-bills. I've given government money, T-bills. And then say, for example, on the 30th day, I feel that I'm broke. What I will do, I'll simply write to the government, tell them I want my money today. And within 24 hours, your money is in your account. So they are liquid investments, saving schemes. But once, ladies and gentlemen, this saving basket is quite large enough, then you should be able to move this money and take it to investment schemes, long-term schemes. And the very best long-term scheme, ladies and gentlemen, is what we call a government bond. And the government bonds, remember, we have the normal government bonds, and then we have infrastructure bonds. Infrastructure bonds, and I normally see those questions in your papers, really. I don't know why students fail in this thing. Infrastructure bonds are those bonds which, of course, you give to the government for the long term. And the government is able to take this infrastructure bonds money and they invest it, for example, in like roads, etc. They take this to the infrastructure. The biggest advantage of an IFB, infrastructure bond, ladies and gentlemen, is the fact that it is normally zero rated in terms of tax. No taxation, no taxation, no taxation. When we talk of personal finance, you must always think about a portfolio. Don't say that Mwalimu told us in this case here to invest all these monies in just government, treasury bills. No, no, no. Government in this case here may go the Ghana way and say we are not going to pay back. So we need to diversify our risk by forming what we call a portfolio, a portfolio, a portfolio. This reminds me of a friend of mine who used to work for Kenya Airways when Kenya Airways was a big thing, a big thing. When Kenya Airways was a big company. In those old days, this guy got about 15 million Kenya shillings, and then he ran very fast to someplace here around Clay City, along Thika Road. Was able to put up a very good apartment. In those days, 15 million, yes, could give you very nicely done 4-floor apartment. The apartment, 15 million was a lot of money those days. Nowadays, 15 million can't give you that kind of a building. For that kind of a building now, you need like 38, 40 million Kenya shillings. So this guy has been able to pump that money into that building, all of it. And then without, in this case here, good notice, one fine morning, he saw those excavators coming, the ones we call Sunny. What is the problem? I never expected to get these kind of visitors in the morning, and they were, of course, doing like this. Why? Because the guy had built his house, his high-rise house, on a riparian land, and the entire thing was brought down. The guy, up to now, he has never recovered. He's living a miserable life at old age. At old age. Why do you think in this case here was he struck that badly? It's because he went for one way. He went for one type of investment. He never diversified. He forgot the old adage of our old great mothers who told us that you shall never put all your eggs in one basket while taking them to the market. If there are 30 eggs, 15 on this basket, 15 on this other basket. So that as you are moving to, even our mothers knew how to catwalk in those old days. As you're moving, in this case, slowly catwalking to the market, should you stumble on a stone and then you fall down, at least it is one, not unless you are, there are also people who are very unlucky. But unless you are very, very unlucky, otherwise it's only one basket that will touch down. So that you don't have all your eggs, in this case, your brain. So whenever you're talking of personal finance, you must always have things to do with what here? Portfolio formation. Ladies and gentlemen, we can't talk of personal finance if you don't look at what you also call what here? If you don't look at what we call budgeting. You must be able to budget. You must be able to do what we call a variance analysis. But for example, I'm getting 500,000 in a month. If I get this 500,000 today as my salary, I have my budget. I know how much in this case I should go to this, like that. So in this case, at the end of the month, after I spend the money, I should be able to compare my budget vis-a-vis my actual and come up with a variances report. Of course, there will be variances. Nobody is perfect in this world. You may have said in this case that you were to put this money here, this money there, and then your mom becomes sick. Of course, you must take your mom to hospital. So there will be a variation. But this variation now must be explained. And of course, in this case here, because you're rational, you're not just somebody who is a spendthrift. You spend money the way that you would simply, you are even pushed by your friends to spend. Then it means that in terms of personal finance, you are illiterate if you are somebody who is just being moved by the crowd to spend. So personal finance is very, very great. So I'm taking like 10 minutes to summarize personal financial management. So I hope you have been able to pick those terminologies like treasury bills, money market funds. You need to invest here, you need a budget, you need to be doing what we call variances reports, etc. And of course, most importantly, ensure that you are forming what a portfolio. And of course, it cannot be a personal financial management plan if you don't have a pension scheme. If you don't have a pension scheme, like now, if you are my age, you are 45 and there, 50 years and there, and it happens that you don't have a pension scheme, trust you me, you are going to live a miserable life. Pension schemes, like when you have a pension scheme with Britain, with CIC, when that pension matures, don't take lump sum, not unless you know really how to handle money. Not very many people know how to handle money. When that pension, in this case here, comes to you at the age of 60, pop, then what are you supposed to do? You're supposed to go and buy what we call the monthly pension plan. So they give you money every month. At that age, you don't go for very many things. Don't start building a very big house when you are 60 years. No, you need money in the government. You need money coming from your pension scheme every month. Just want something, because even at that age, some little diseases have started taking toll on you. All right. So you need some small monies here. You have these. You can't talk of personal financial management if you don't have a medical plan, because just a simple disease like this can really throw you to hell financially. It's about risk management. It's about risk management. It's about risk management. It's about risk management. Explain about. Yeah, please feel free to ask questions. Yeah, or explain the pension towers. Yeah. I don't mind repeating that story because I normally talk about it quite a lot. I don't know how many of us have been near KRA towers. You'll be able to see the CBK pension towers. CBK pension towers. These pension towers, if you are keen enough, you must realize that they are not straight. There are two of them. We have one bending like this, that is Tower A. And then we have another one bending like this, that is Tower B. So when you can even Google today, what was the inspiration for building towers that are inclined, that are bending? It's very easy, because these pension towers, they're looking at what here? I mean, whether you like it or not, Yvonne, Aggie, we have Anne, whether you like it or not, right now you are young, you are able to wear your high-heel shoes and you are able to match, you're able to, in this case, just step very strongly. But trust you, ladies and gentlemen, after some time, whether you like it or not, you shall bend. Once you hit 65, 70, wanakuambia mami, umechapa. Mzee, mileage imeisha. Kama yangu sasa imeanza kuisha already. So nakuuliza now, this particular time when you are at the age of 70, when you are bending like this, is that when you would want, ladies and gentlemen, in this case here, to start working so hard? No. If you had invested, like these guys have a very big base. If you had invested in this case here very well in a pension plan, then you will be drawing your pensions from this thing when you are bending there. And remember, these A and B, these are man and wife, and chances are, when you are that old, please pray hard so that you don't get to bend in opposite directions. If you happen to bend in opposite directions where you're not able to see each other eye to eye, the one who loses most is the husband. Because most husbands, we are not very good with personal financial management. A woman, give a woman 10,000, she'll be able to keep something by the side. When you are 60 and you used to have a very good job, 75, most of these guys tell us that they don't even have a single penny to buy water Panado. So they go to their wife. So once you become, in this case, you're bothered to that wife, the wife, of course, will get her way and join the sons and daughters in America. And then now you're left with a pauper. You start making one mistake from another. You marry a young one, you die. You die. It's called personal financial management. Does it make some sense? Does that topic make some sense? We shall overcome. We shall overcome. We shall overcome. We shall overcome. So I can see girls here who are really sympathizing with us. Please, wherever you are, as a young man, as a young lady, like today, if you have like even 1,000 bob, please send it to your old man. You know, your old man may not talk a lot, but people really are suffering. All of us will tend to put all our weight in our mothers, which is still good, but please, Also remember Mzee. Remember Mzee. Thank you so much. Thank you so much. Thank you so much. So that then marks the end of my this presentation. I have a meeting at exactly 10. I would want to continue. I don't know what time. Again, you're free for us to continue with effective interest rates and other great things. Other great things. Right now at exactly 10, I'm supposed to join some meeting. Are there students in this case who have never seen this Mwalimu before? Are there students who have never seen this Mwalimu before? This is their very first time. Their very first time. Ah, Gabriel. Oh, okay. Great. So my name is Dr. Joshua Aura. All right. I teach financial management, advanced financial management, business data analytics at RCM Online College. So basically, I've just come because I saw some of you are panicking a little bit, just to ensure that I cover some areas that you guys are not very comfortable with. That is why I would want us to talk about those areas on WhatsApp. And if you realized, on your WhatsApp, I've sent you some 4 videos. I've sent you some 4 videos. Have you guys been able to watch those? Is there anybody who has been able to watch all of them? Is there anybody who has been able to watch all of them? Is there anybody who has been able to watch all of them? Or even 2, or even 1. Valuations, thank you, Yvonne. I've done 2. I've just started. I've just started. Great, great. So the guys who have watched 1, 2, 3, are they videos that you guys have enjoyed? Have you learned something out of them? Have you learned something out of them? Have you learned something out of them? Ziko fitting. Now, have you promoted Mwalimu? Have you been able to, in this case here, subscribe to his YouTube channel? Have you made a comment? You need to take this Mwalimu International. You need to make Mwalimu go to Harvard, make RCM become Harvard by ensuring that his channel is very, very popular. It's very, very popular. So have you done that? All right. Thank you very much. We shall be meeting again. I'll be sending a link in a few minutes after I finish this. Thank you very much. Thank you very much. Thank you very much. Thank you very much. Good day.